In this session, we will be dealing with understanding of publicly traded real estate securities. So, when I mean by publicly traded, it's not a direct investment in real estate securities, but probably some kind of a funds kind of an investment, wherein investors invest in a pool typically called as real estate investment trust, and this trust or this pool of money, it may be a real estate investment trust, or we will be talking about real estate operating companies, or it could be mortgage backed securities, any of them. Investor is investing in these funds, and these funds in turn manage the real estate properties or give some loans to get involved in the lending process to someone who is buying the real estate. So this is what is a publicly traded real estate security, wherein the end user is not directly buying the real estate, but he is still investing in the real estate industry and enjoying the returns which are generated by the real estate market. And these securities, where the underlying is the real estate properties, they are publicly traded, just like a stock is traded on a stock exchange. Even the shares of these real estate securities are also traded, just similar to a mutual fund. Probably when I talk about the publicly traded real estate securities, you can draw similarities with respect to a mutual fund. Investors invest in a fund, and a fund in turn gets invested in stocks and bonds. And the investors, they can very well pull out or get into the fund at any time, or they can buy the shares of the fund just like they buy the shares of any other company on an exchange. The same logic works with REITs. Probably you can treat the publicly traded real estate securities as a special case of mutual funds, where the pooled amount is invested in real estate market itself. Right? With that as a base, when I am getting started, typically in the publicly traded real estate market, I see three major types of investments. One is real estate investment trust, which is more like an equity form of an investment. Then we have real estate operating companies. So people can invest either into an REIT, or they can invest into a real estate operating company, which is also an equity form of investment, or they can invest in mortgage backed securities, which is more like a debt form of an investment. When I say this equity or debt form, from an investor's perspective, he is just contributing money to this pool. So this pool, I call it either as REIT or REOC or MBS. I may call this pool by some name, but this pool in turn, it invests in, let's say, equity market. It invests in the real estate market in the form of equity. Means whatever the returns that this real estate generates, that is paid to the investors. So the investors, they are given a kind of an equity stake on the real estate market, depending on whether that real estate investments are generating more returns or less returns. The investor has to bear all those kind of things. That's the reason we say that it is an equity form of investment. Whereas in case of mortgage backed securities, probably a predetermined kind of an amount. Okay, they will be given a coupon rate, 6% every period. So a coupon is defined, a principal is defined. So even if the real estate is performing extraordinarily well or very badly, the investor in MBS may be getting more or less similar kind of returns, whereas if it is investing in REITs or REOCs, because they are equity form of investment, the returns can vary also. But yes, when I have to compare between what is REIT versus REOC, couple of things. REITs, they are exempted from corporate tax. So it's a very interesting set of trust. It's a trust that is set up where they are exempted from corporate taxes altogether. But the way they get that exemption is they have to invest whatever the proceeds they are collecting from the investors. They have to invest majority portion in the income generating real estate. Income generating is more get into the process of rentals. So they invest in the real estate properties and give that property on a rental basis, not for buying and selling of the properties. Then when they are getting into the process of buying and selling of the properties, they don't get qualified as REITs and they don't get that tax advantage only if they are getting into the investment in the income generating property, and also they have to distribute the entire income at the end of the year. They cannot retain the income for the next periods. So it cannot result too much in capital gains or income accumulations and all, because whatever the income they are generating, to a large extent they have to distribute that income. Only under these criteria they are exempted from corporate tax, and that makes them one of the powerful tools with respect to the investing in the real estate market. And that is one major criteria that differentiates real estate investment trusts from real estate operating companies. And just to add a little bit more to it, they are actively managed, means a professional management exists, which means I don't need to really bother about developing the expertise in the property. That is what we used to do when I have to purchase an individual property for a direct purchase. I need to really evaluate the property thoroughly before I make an investment, because huge amount is involved in it. Whereas here, this is actively managed just like a mutual fund. So, though many times we find this REITs, they specialize in one type of property. Probably it's like residential or hotels or office spaces. You find so many such, or probably retail. Because the characteristics of each of these different types of businesses differ based on the economic situations and various other aspects. So most of the time the REITs specialize in one major form of the property type, but you may even find diversified REITs also. And the major ways they can generate the profit is one, growing the cash flows, which is more like increasing the rentals. So based on increasing the rentals, they get more income, which will increase their profits. And they purchase additional properties. That is the way they grow, because they cannot retain too much. Right, so to grow, probably they have to raise more and more capital. So we will be seeing even later, they issue secondary equity to a large extent. They keep issuing new shares if they have to grow, because for whatever the income they have generated for the year, they cannot retain it in order to get that corporate tax advantage. So they are distributing that entire income, which means if they have to grow, they may have to issue a secondary equity, and that could contribute more and more, or probably improve the existing properties, which could again result in increasing the rentals, which could give them the additional profits for the future periods. Whereas when I look at real estate operating company, whichever the companies which are investing in the real estate, and cannot qualify to become REITs, they get established as REOCs, which means they don't get any kind of an exemption in the corporate tax, but at the same time they have the flexibility that they need not invest only in income generating real estate. They can even invest in the real estate with a purpose of buy sell to a large extent. So they can they have a lot of more flexibility. They can retain the earnings. They have lot more flexibility compared to REITs, but on the other side they have a problem with respect to the tax advantage. So that's where we see the other set of companies which invest in real estate, called as the real estate operating companies. These two are primarily the equity forms of investment. But on the other side we have a debt form of an investment. Again, the investors pool money, and that pool is in turn investing in residential and commercial properties as a lender. So that is which means, because it's a lender, the based on the EMIs that are received, right, based on the EMIs that are received from the borrowers, the investors of MBS will be compensated accordingly. And the same way mortgage REIT is also like, it's a real, so it's again the pool of money is invested either for lending, giving loans to someone directly, or they in turn invest in some other mortgage securities, which again to an investor it generates the cash flow in terms of the interest payments as well as principal payments underlying the original loan. So whenever we are talking of equity form of an investment, all the investors will have ownership stake in the properties. So whatever is the return that is getting generated, that in a proportionate manner gets distributed. It might be a gain or a loss, but it would be distributed in a proportionate manner, just like any other equity form of investment. Now, why should I look at a publicly traded real estate investment like REITs rather than a direct investment in a property, direct purchase of a property? One, direct purchase of a property loses liquidity because of huge costs involved, and at the same time I cannot sell the property whenever I want. There is a illiquidity issue associated with the property. But here, when I go with REITs or any of these publicly traded securities, there is a lot of liquidity. Whenever I want, I can sell them at the prevailing market price, because there is a lot of volume trading involved in these kind of securities, because they trade on a stock exchange just like the liquidity associated with the stock. Even these securities also have a similar levels of liquidity. Then minimum investment is very low. If I have to purchase one direct purchase of a property, probably it may cost me a few millions. But here, with very minimal amounts, I can get into the investment of REITs advantage. So which can help me, if I have the same million with me, probably I can diversify very heavily, because I can get exposed to the investment in different properties in different geographies, having a small proportion of the ownership stake in the entire property rather than having a direct possession of the entire property. So I will be getting the benefit of the rentals of multiple properties of multiple types in multiple geographies with the same amount, rather than exposing myself to one single property and exposing myself to a very huge risk. So the minimum investment for each REIT is much lesser compared to a direct investment in real estate. The liability is limited to the amount of investment, because it's an equity investment. I may get whatever benefit I get, or maximum I lose to the extent of my investment. More than that, I am not supposed to sell off my personal properties to pay anyone else. So my maximum loss is the extent of amount which I have invested in it. Whereas in case of real estate, it may so happen that I may have to bear a loss beyond whatever I have invested also, and it gives me an opportunity to invest in high prestigious, high value projects. If it is a direct investment, probably a big shopping mall in the center of the city may be too expensive for me, but going with this mechanism, that investment may be still possible because my contribution is only a small ownership stake in the entire investment, which I can very well get into, and probably I can get the benefits of the rentals and capital appreciations of the property, which is high value and more prestigious, and here professionally managed, so I don't need to develop my own expertise in terms of evaluating the properties or understanding about the rentals in each of the areas, the expenses that are incurred in managing that property. That kind of expertise I need not develop because the entire REITs are professionally managed. And the other thing is, because these are listed on exchange and they are publicly traded, to a large extent, whatever is the financial reporting requirements as well as the corporate governance requirements, including the board elections and the acting on behalf of the shareholders, all these things are applicable even to the REITs, which make them much more desirable compared to a direct investment in real estate, and they exhibit highest levels of financial and operational efficiency because of their expertise, their being able to manage multiple properties and in a professional manner. They exhibit high levels of operational and financial efficiency. Because of all these things, it is advised that an investor can very well go for investing in REITs compared to investments directly in a real estate property. But at the same time, along with the advantages, the investment in real estate, publicly traded real estate, is exposed to a few disadvantages also. If we remember, we were talking about an investment in real estate, apart from the diversifications and all it offers, it also offers tax benefits to the investors, right, in terms of some deductions with respect to the interest paid, with respect to the principal paid. So there are some tax benefits with respect to the real estate investment, but that kind of tax benefits are not possible when I am investing through REITs. A direct investment will give me some kind of tax benefit, but an indirect investment in the form of REITs does not give me that kind of a tax benefit. So it's a weighing between the tax benefit versus the other benefits that I am getting with respect to a REIT investment. And at the same time, the investor does not have the control which properties is this REIT investing in, what kind, in what location, in what business, what type of REIT or what type of REIT investment is it? Is it more into office spaces or hotels or retail, or what type of REIT is this? That way, that kind of flexibility is not much available to the REIT investor. And because it's a public traded kind of a company, there are though it is giving you all kinds of reporting requirements and corporate governance and all, that's an additional cost, right? So that additional cost may bring down the profitability to that extent, but at the same time the risk is also reduced. So again, it's a trade-off. And because this is listed on the market, the price is more or less determined by demand and supply, which means the volatility of the prices is very high, just like stock prices. The volatility of the REIT prices is very high. Here we need to talk about a small different model of REITs called UPREIT and DownREIT. Up is umbrella protection, umbrella partnership, wherein, see, the structure works like this. The REIT as a fund. REIT is nothing but it's a fund. It does not directly invest in real estate property. It invests in the real estate as a partner. So along with Mr. A and B who are partners in this property, the REIT also enters as one of the partners. This kind of a setup is called as your umbrella partnership REITs, REITs. So here the REIT is not the only player in this entire property. It's a partner along with the other players. So in this case, what happens? There could be a conflict of interest between these people and REITs, which could cause, in sometimes probably these partners, they want to take decisions which will benefit them rather than the shareholders of REIT. This is where there should be a care that needs to be looked at. REIT, is it a general partner in the real estate investments, or is it a kind of solely investing in the properties? So this is one model that needs to be looked at. These are called UPREIT kind of models. Whereas in case of a DownREIT model, it could be the same REIT, it is having ownership interests in multiple partnerships. So another property, another partnership, and again it must have invested in another partnership, another property in another partnership. So this kind of an REIT is called as the down REIT. So there, which means REIT is owning properties at the partnership level as well as at the REIT level. So these could cause potential conflict of interest between the partners and the shareholders of REIT. So this is one thing that we need to be aware of with respect to the REIT investments. Then the future income growth is very limited because capital appreciation is not that much possible with respect to REIT. Whatever the income they have generated, they have to be distributed to a large extent, which means there is a possibility of reinvestment risk in case the interest rates and all are very low during a period. So that's one more disadvantage. And because they have to raise capital at regular intervals of time, to a large extent they get into the borrowing process. But if the debt is not available, they may have to issue equity, and that equity may have to be issued at a much unfavorable price, which again will cause some kind of issue with respect to the profits or returns generated by REIT investments. So that's one more side. And they have too many restrictions with respect to what kind of investment they have to do. They have to do only a rental income generating kind of investments. Very rarely they can get into the buy sell kind of transactions of the properties. And even the income whatever they are receiving in a year, they have to distribute a large proportion of it, so and they cannot retain it. So because of those things also, they are exposed to some level of disadvantage. And when we see the investments in REITs across the industries, they are basically driven by GDP growth, which would in turn result in more jobs getting created or more people spending power increased. All these things are they requiring more and more housing, they requiring more and more hotels, and all these things grow once the GDP growth is higher. It is heavily dependent on the GDP growth. But apart from that, we also see population growth or retail sales growth contributing significantly to the growth of REITs. Even more new jobs means office investments are much higher, right? More new jobs means new residential apartments and all, the demand for them will go higher. Probably new shifting of the jobs and all, even the hotel REITs can have more and more demand. So what we see is each of the various factors have a different impact on the performance of these REITs. So more demand, more investments in those particular types of REITs and vice versa. So that's where when I look at the key investment things, what separates an REIT from the rest? They are exempted from corporate income taxes, but at the same time they have to make sure that they are investing a significant portion of their money in of the fund value in income generating real estate only, and most of the income that is generated, it needs to be distributed. So that part needs to be taken care of. The dividend yields are very high compared to any traditional stock and bond investment, which means an investor who is more focused on regular repeated incomes probably can target REIT investments very heavily. Volatility is much lower for the cash flows because most of them are invested in rentals, and rental income is more or less stable over a period, unless there is a lot of vacancy rates and occupancies fall drastically. Unless all those things come up, to a large extent there is a stability in the income that is generated in the form of rentals. So that's where the volatility in terms of returns is much lesser. The price of REIT is much higher, or the volatility of the REIT prices in the market are much higher because they are traded, but the returns that are coming on the REIT investments, they are more or less stable. And secondary equity issues are much higher because they require continuous capital, and they cannot retain the existing income that is getting generated on a regular basis. Otherwise they will have to forego on the tax benefits that they are typically getting. And from the risk dimension, if you have to look at the REITs, the major risk they are exposed to is how they are invested, based on where they are invested. If the investment is in a sector where demand and supply mismatch is very heavy, probably we do not get the benefit that we are expecting out of the REIT. Or the sector which is exposed to very heavy fluctuations in a short term. The occupancy rates fluctuate very heavily in the short term, especially hotels is the space where you find very uneven demand. Seasonality acts as a very big issue. In those kind of sectors where the occupancy rates fluctuate very heavily, we may or may not get the required rate of return. So we are exposed to very heavy risk investing in those kind of REITs. And depending on where the investments are, the location, the quality of all those investments of the REIT needs to be very seriously evaluated. Otherwise there is a great exposure to risk with respect to the REIT investments. Then, so as an investor who is looking at investing in REITs, some of the due diligence aspects that need to be considered. First, look at how many are what is the lease terms of majority of the investments which this REIT is invested in. How many years of lease is still more left? What we need to bother about, why we need to bother about that is, if there are only one more year, I mean the lease is only for the next 1 year. What could very well happen is, if the economy is good, probably there is a scope for me to increase the lease rentals the next year based on the market condition. So there is a chance that I as an investor am going to get more better return the next year because the lease period is getting over and a fresh lease can be written. But at the same time, if the next year the economy is going to be a falling economy, probably I may have to, I will be getting a lesser lease rentals because the rentals may fall in the next period. So that's one thing. Or probably on the other side, if the economy is not doing so good, probably a long-term lease. So there are 10 more years for this lease contract. So in that case, at least I am safe for the next 10 years, even though the economy is not doing well. This particular property is leased for the next 10 years, which means the rentals can be collected for the next 10 years. So I did not bother about the returns which I am going to get on these REITs. So especially when we look at a growing economy, as an investor, the short-term leases are much better. But if I am looking at a falling economy or fall in the rental market, it's better to look out for long-term leases rather than short-term. So generally we see shopping centers and offices get into the long-term lease agreements, whereas the typical residentials and hotels, they get into a short-term lease agreements. And the other thing that is a good due diligence to be done is whether there is an inflation protection, which means the leasing, okay, there is a 10-year lease. This property is leased for the next 10 years. But is the rent more or less fixed? Or is it growing every year by 5% or 10%? Or is it growing along with the inflation? Is it tied to some inflation index? Because if it is tied to some inflation index or if it is increasing by some percentage every year, at least there is a chance that I am receiving certain more money compared to what I am receiving earlier. But if it is a flat amount for the entire lease period, then probably there is going to be a lesser return for me in the future, because though the market rates have gone up drastically, I am receiving a lesser. The other thing is compare the rentals, REIT versus the market. Sometimes what could happen is, because the lease is taken for the entire, let's say 10-year period, the rents are decided, whatever the rent is decided is maybe slightly more than what is the market rent at that point. So let's say the market rent at that point is $25 an SFT. Probably this REIT may be available at $30 per SFT flat rate for the entire 10 years. So in that case, okay, this year probably the REIT rent could be much higher. But you have to remember that is for the entire 10-year period, which means in future my cash flows are really going to drop, because the current REIT rents are much higher than the market. And along with that, one more thing which is worth looking at is, what are the costs that are typically incurred in releasing once the lease period is over and I have to release the property. What are the various costs that are getting in? For few months I won't get my rent, which means the investor also will not get his returns. The broker commissions may have to be given, especially if the new property is shown by the broker. And the cost of improvement for new tenant, he may demand a few more modifications and improvements to the property. So all those things need to be checked out if they are going to be very high, or if the lease period is going to be ended in this year or in the next year, and if these costs are inevitable, probably the return which the investor is getting is much lesser. So these points need to be evaluated before considering a particular REIT for investment. And what is the financial position of the largest tenant? Is that largest tenant in that particular premises, is he financially solvent? Is that company financially solvent, or any such kind of legal or any issues lying, or even the financial, what is the kind of financial strength or health of that particular company? Because if that company stops paying it might become very difficult to find another big company which is similar size to this one and give this entire bigger space to them. And at the same time, you should also look at the tenant concentration. If it is only one big client rather than 100 small clients, the risk is much higher. If that particular client goes off after a few years or stops paying after a few years, it's going to be a big painful thing of lost rents and all, going to a very big impact. Though you are getting something considerable in the short term, but it may have a big impact in case that tenant leaves the premises. So even that needs to be looked at. And also look out for the new properties that are getting developed in that area. More and more properties coming up in that particular area can result in more competition, and which means the falling rents, which means falling returns to the REIT investors. And just like any other financial analysis of a company, it is advised to do a thorough financial statement analysis of the REITs, especially from the perspective of the solvency. And because the REITs are more and more professionally managed, look at the credentials of the management, their earlier successes, their qualifications, and few more things before deciding which REIT is worth for investment at this particular moment. And as we were discussing earlier, the REITs come in various types depending on which business they are investing in. There is a retail REIT, there is office REIT, residential, healthcare, industrial, storage are diversified. We find so many such kind of REITs. So basically it's nothing but the pooled money is invested in retail spaces. So in retail, especially as long as the consumer demand is existing, more consumer spending is there, more demand for retail spaces will be there. So at least in the short term, the revenues are more and more stable. When it comes to office, more jobs getting created and more population coming into that particular country or city or location, that can create more and more demand for office spaces. And so generally for office spaces, the lease periods are slightly higher on the longer term, 5 to 25 years. And the rental, change in the rentals, that is going to impact the demand very heavily. But when it comes to residential, most of the times we see a very short term lease. But of course, as the population is growing and as the job market is getting created, you find more and more demand for residential properties coming up. When it comes to healthcare REITs, in general the leases are given as net leases, where the tenant will take care of all the operating expenses also. So in this case, again, the social demographics of the persons, of the people in the country, along with the government funding, will have an impact on these kind of REITs. Coming to the industrial investments, again they are leased for a longer periods because they are less cyclical. They are not that much exposed to huge business economic cycle fluctuations and all. But on the other side, when you look at hotel based or something which is very heavily dependent on season as well as business cycle, the income is going to be very volatile, and the lease periods also are not for a longer term at all. And there is a concept of storage REITs, where typically we see mini warehouses kind of thing being created for individuals and small businesses if they want to store their something for very short periods, generally rented on a monthly basis, especially if people are moving from one location to other location, or if the businesses are shifting for a very small period, they can operate from those kind of locations. Or so generally they are given on a gross lease on a monthly basis. The owner itself takes care of the operating expenses for that space. That is what we call as gross lease. They are given generally on a monthly basis. So again, finding the right set of continuously being able to find the tenants is a challenge here. But as long as the businesses, new businesses are coming up, or as long as the residential properties are coming up, you find lot of demand for these storage REITs also coming into picture. And diversified is generally the REIT doesn't specialize in one type of investment like this, but they try to diversify themselves across the various forms, which are generally common in Europe and Asia, but very less common in the North America. Now, the next site in terms of getting into the valuations of REITs. So before we get into the process of valuation of REIT, we are more focused on a concept called net asset value per share, because most of the mutual funds also, they are based on the net asset value. So because this is more and more similar to mutual fund in operation, we are trying to compute the net asset value even for this REITs also. The net asset value is nothing but the total assets and assets minus the liabilities, but that is based on the current market value and not as per the accounting book value, which means it's a real reflection of the current worth of assets of this company, net assets of the company of the REIT. So probably from an investor's standpoint, that would reflect the value to the investor at this moment. It need not be the price, because it is traded on the stock exchange. So the price may be different from the value. So value is primarily derived from what is the worth. Right now these are the assets of the company and these are the liabilities. So this is the net. So in case the company gets winded up or something, they would be getting a proportion in the assets of that company. So that's how this can help them to understand the value, but the price which they are paying for it could be either much more than the value or much lesser than the value. But at least the NAV is a kind of a yardstick to measure the value or worth of that particular investment. So it can even suggest based on the price. If the price is more than that, we say that this particular REIT is overpriced or overvalued, or underpriced or undervalued if the price is lesser than that particular value. So the way generally it is computed is, find the capitalization rate first. How do I get the capitalization rate? You can find out, you can identify the comparable properties, property 1, 2, 3, which are comparable properties or comparable transactions which have happened very recently for the comparable properties. Just find out what is their net operating income, right? Net operating income we have defined earlier. It is nothing but gross potential rental income, right? Gross potential rental income minus, you adjust it for the vacancy losses or collectibility losses, and at the same time you also subtract the operating expenses which are more and more specific to the property in terms of property tax, in terms of insurance, in terms of utilities, repairs, maintenance. These are some of the things you subtract, where you don't subtract the financing costs and all, and arrive at the net operating income. So the net operating income of each of those properties divided by their sales price. So this gives the capitalization rate separately for each of these transactions of similar kind of properties. Take the average of all these capitalization rates and decide on one capitalization rate. That is what we are doing as a part of computing the market rate of return, which is the capitalization rate, by comparing the recent transactions of similar properties. So that is what is the capitalization rate. Now compute the NOI, net operating income of the current company, the current REIT. Find the net operating income of the current REIT. The only thing is net operating income, whatever you compute by doing all that, here you subtract. Some adjustment is being suggested here. When you are taking the net operating income, you subtract non-cash rent. What is the non-cash rent? See, let's say we have taken an agreement for this entire period saying, okay, 20, 21, 22,000, 23,000, these would be the rentals for the next 10 years. Every year the rent will increase by 1,000 bucks. So, let's say when I come to this year, the rent which I am paying is actually 22,000. And at the same time, I'll take the average rent for this entire lease period. Average rent for the entire lease period, let's say it is coming out to 25,000. That is what we actually call as contractual rent. That is what we actually call as the contractual rent. That actually goes into the computation of NOI. So if at all I really have to include only 22 and not 25, I subtract the 3,000, which is the difference between the contractual rent, which is the average rent for the entire lease period, minus the actual rent that is paid. So that difference is called as a non-cash rent, which would be subtracted from NOI. And along with that, I would also add full rent for properties acquired during the year, because if I have acquired the property during the middle of the year, this year, let's say I have acquired the property just 3 months back, then my NOI actually will reflect only the 3 months kind of a rent. But had it been 1 year, what would be my typical rent? So that is the number I would be considering. So I will add back the full rent for the period and say this is my adjusted NOI. And this adjusted NOI, this is the historical. I increase it by the growth rate to find out the next period NOI. And I will use that next period NOI divided by the capitalization rate to arrive at the value of the property. Capitalization rate, which I have got in the earlier stage, the net operating income, which I will get by following those 3 steps. First, find out the net operating income using the gross potential rental income minus vacancy cost minus collectibility losses minus other operational expenses. So to whatever the NOI I got, you adjust it by subtracting the non-cash rent and adding the full year rent for properties which were acquired during the year. Arrive at adjusted NOI for the last year. Multiply that adjusted NOI with the growth rate to find out the expected NOI for the next period, and use that expected NOI for the next period divided by the capitalization rate to arrive at estimated property value. And you add all other assets whichever are there, like cash, accounts receivables, all the other assets, any prepaid expenses, all these other assets you add. But generally don't add the goodwills and deferred tax assets kind of items, but the regular tangible assets you add them, and you also subtract the typical regular standard liabilities and arrive at the net asset value of the REIT divided by the number of shares to arrive at net asset value per share, which will typically give you the approximate value of this REIT. The other ways require computation of one more important aspect called fund from operations FFO and adjusted fund from operations. The way the fund from operations is computed, just like calculating a cash flow, just like calculating cash flow from operations, or so if you see here, accounting net income. So when we are computing even the cash flow from operations, we add back the depreciation, we add back the deferred tax expenses, whatever are there, minus the gain or losses from the sale of the properties, because they are not a part of operations. Gain or loss from the sale of property is not a part of the operation. So we subtract that, which will give me the fund from operations as that particular number. But so this is more similar to cash flow from operations. If we are looking at it in a regular financial statements manner, this is more similar to that of cash flow from operations, whereas this is more reflecting a kind of free cash flow, because from the cash flow from operations we subtract non-cash rent, which we have discussed earlier, the difference between the contractual rent and the actual rent. So I am subtracting the non-cash rent. All the maintenance type capital expenses and leasing costs are getting subtracted to say this is the amount of cash that is really available for distribution to the investor, which is again similar to the definition of free cash flow. So this is the amount of fund that is really available for distribution to the investor. So adjusted FFO is much better than a regular FFO in terms of valuation. But one thing we have to be careful of is all these are big assumptions. So because it takes into consideration more number of assumptions, it is more and more subjective compared to FFO. So we need to understand even that aspect before getting into the typical investments aspect, in typical valuation aspect of that REIT. So looking at the various valuation methods, we are talking of three different. One is the net asset value per share, which we have discussed to some extent. Then there is the relative valuation mechanisms using the ratios like price to FFO ratio and price to adjusted funds flow from operations. So the industry standard P to FFO ratio or the sector average P to AFFO ratio are typically considered and multiplied with AFFO per share or FFO per share to typically identify what should be the value per share for each of these REITs. Or the most traditional aspect is the discounted cash flow mechanism, because you see most of the times these REITs, they distribute the income, so it is more like a dividend. So just like a dividend valuation, dividend discounting valuation model, we can apply a discounted cash flow technique, probably projecting the dividends for the next few periods at some rate, then for few more periods at some rate, and then perpetuity at some other rate, discount all of them to the present value to find out what should be the value of this REIT. But of course, for the number of periods and the growth rate, all of them are subjective. So the same and even finding out the terminal value at this rate, all these are more and more subjective. So that's where the enough effort has to go in terms of prediction. If at all we are using a discounted cash flow method, a 2-stage, 3-stage, any such kind of dividend discounting model can very well be used for predicting the value of the REIT. So we can take one simple example to work out on all these things, which can give us some level of confidence in terms of how we can use all these models for evaluating for finding out the value of REITs. So let me take one simple number base here. This data will reflect almost all the methods which we are talking of. So So a lot of details being given. Estimated NOI for the next year. So this is not historical because it's an estimated for next year. The last year's FFO is given. So from this probably I may have to find out AFFO. Okay, let me look at now that FFO is given and the number of shares is given, I can find out FFO per share. So let's look at a few calculations here. Right, I can find FFO per share, which comes out as 277.9 divided by 31.1. This is giving me FFO per share, and into whatever is the average price to FFO ratio for the industry, that is 13. Multiply these two to find out the value as per FFO. Using the value as per FFO means we find the FFO per share multiplied by average price to FFO ratio. So as per this, it says the value of this particular REIT should be $116. So that is the FFO per share, FFO based valuation. Now I can say AFFO based. So for that I have to compute AFFO. How do I compute AFFO? I can first take FFO. Okay, what is FFO here? 277.9 is the FFO. From there I subtract the non-cash rent 14.1 million. So I subtract non-cash rent, and I should subtract the maintenance type. Maintenance type capital expenditure of 31.7 million. If I subtract, that is what is giving me the AFFO. This is AFFO. So from here I can find out AFFO per share. So that this AFFO divided by number of shares 31.1 million is giving me AFFO per share of this much. So again, value is, you take the AFFO per share and multiply it with the industry average price to AFFO ratio. So price to average AFFO ratio is 20.4. So using this mechanism, it is saying that the value is around $152, right, for this REIT. Using the AFFO base, the value of this company should be somewhere, value of this REIT should be somewhere around $152. Then similarly I can look at the net asset value. Okay, for that I should start with the capitalization rate. Okay, simple thing, anyhow they have given the capitalization rate directly. So otherwise I should compare the NOI to the property values of the various comparable properties and then take an average to compute the capitalization rate here. So now that I have the capitalization rate and also the NOI is available as 282.4. So probably at least I can find out the value of the property, which is nothing but NOI, expected NOI 282.4 divided by the capitalization rate, which is 12.6%. So the expected value of the property is somewhere around 2,241 million, and other assets need to be added. Add other assets. So to this I add, what else? Cash is there, 257.4. Okay, accounts receivables is there, 133.4. Okay, only that much, right? So I can very well take this to be after the addition of other assets, Probably this is what is the value. Then subtract the debt. So from this I subtract what is the value of debt, 868 million, working out to 1764, and I don't have any other liabilities, right? I don't have any other liabilities. So this is my net asset value then. So NAV per share is nothing but net asset value divided by number of shares, 31.1 million, which is saying as per this mechanism the value of this particular REIT is just around 56. So different mechanisms are giving me different kinds of values in this. So that there is probably some issue with respect to the collection of this data, otherwise most of the values should be more or less in the same range. But just to understand the process, we are trying to work around with all these things, right? And then if at all I have to use the DCF approach, for this I need to know the dividend, right? Okay, from the next period onwards, what are the dividend? The expected dividend next year is 12.1 million, and after that it is going to grow by 5% for the next 3 years. So in the next period probably the dividend is going to be 12.70. so I can find out for the next 3 years 12.70, 13.34 and 14, and from this it is going to grow at the rate of 2.6%, right? So because from this year it is going to be a constant growth for this entire, I can very well find out the terminal value here, right? So these are the dividends. So I can find out the terminal value from the period of the growth. So T1 by KE minus G. KE in this case is 17.6% minus the growth rate 2.6%. So this is what is coming out as the terminal value, and these are the dividends. So I can find out the present value of all of them discounted at the rate of 17.6%, right? Each of these periods I can discount by 17.6% to arrive at the present value. So basically it's like I can take the cash flows. So this is the next year, and for the next 3 years and probably the last year I can take as summation of these, and I can find the net present value based on the discounting at the rate of 17.6%, right? At the rate of 17.6%, I can take these as the future cash flows. This is after 1 year, this is after 2 years, after 3 and after 4 years. I can discount these future cash flows to arrive at the value of the NPV, which is at around 85. So which means when I am using this particular approach, which is the discounted cash flow kind of an approach, I am assuming that the value of the REIT should be somewhere around 85. When I am going with NAV per share approach, it's working out that the value of the REIT should be somewhere around $56. Otherwise, so this is dividend per share. As long as these are all per shares, these are all per shares itself. So I don't need to bother about reducing it to per share here. whereas here the per share value is $56. In the AFFO based it is $152, whereas in FFO approach it is around $116. So that's how we are trying to work out, finding out the value of the REIT using various mechanisms. So this is what we need to be more comfortable with as far as the understanding of publicly traded real estate securities is concerned. I hope you might have got a decent level of clarity in terms of understanding of all these aspects. Any further queries you have regarding any of these topics, you can very well get back to me by giving me a call on this number, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.